Hey everybody, it's Todd Seymour again on Let's Talk Money, and today's topic is mutual fund review. And I wanted to do a video just solely with mutual funds because out of the three things that you can invest in pretty much with stocks, exchange traded funds, and mutual funds, out of the three, mutual funds are to me the more complex because there's so many of them, and that's the reason why they get overwhelming. So let's talk a little bit again about, first of all, what mutual funds are. So mutual funds are a active investment, and what that means again is that, using our example previously, I own Amazon and I can own it by itself and it's super expensive, or I can buy this mutual fund with this big bubble and I can have all these other stocks and bonds along with my Amazon. Much cheaper to buy it that way than it is to go out and buy the stock by itself. And it's a way mutual funds are to diversify risk. And I can do that again because I've got so many different positions. It also allows you to participate in stocks cheaper, right? Because I can, instead of paying $2,300 for Amazon, I can go look for mutual funds that hold Amazon that are much cheaper. And this is why we always talk about, I don't need thousands and thousands of dollars to invest. I just need bits and pieces at a time. Because the beauty of mutual funds too is it allows me, or you, to buy fractional shares. And what does that mean? It means that if I have $50, I only need $50 and I can buy a piece of this mutual fund. I don't have to buy chunks of stock. I don't have to buy the entire stock or whatever. I could just take $50 every week or every once in a while and just buy pieces of it. And then at least I own still Amazons and Googles and all different kinds of stocks if you're going to buy a technology mutual fund. It's just a great way to do that. And that's why these types of funds are usually, they're common, let's call it, in retirement plans. And it's because, again, when you're investing and they're taking money away from your paycheck every week or every 2 weeks or however frequently you get paid, that's what's called dollar cost averaging. Is every pay period you're just buying pieces of the mutual fund, and over a period of time the shares add up because as you keep buying these, they keep reinvesting and keep buying more pieces of that bubble, and your investments get bigger. So that's the beauty of mutual funds, is that you can buy it with small pieces of money over a period of time, and it allows you to be diversified. So we put on here diversified risk, active investment, participate in stocks that's much cheaper, right? We can buy pieces of it because we can buy fractional shares. The most complicated thing about mutual funds, well, there's a couple things admittedly, and that's why I kept the resources on here for you as an individual investor. If you wanted to do it by yourself, is you can go on the fund analyzer through finra.org, and that's a government-run institution that if you go on finra.org and scroll to the bottom and you click on fund analyzer, it'll allow you to put what's called the ticker symbol of the mutual fund, and it will dive inside the mutual fund and tell you what's inside it. Or Morningstar is a great resource that we use all the time too. When I know I own Amazon, I know what I own Amazon. But if I own ABC Technology Fund, I want to see how much of Amazon is actually in that fund. Those two places are a great resource to tell you how much of Microsoft you own and how much Facebook, all these different companies that are inside these different mutual funds. It's kind of neat to see as an investor that you own the stock, you just own it differently. That's all. To me, the most confusing thing when it comes to mutual funds is the fee structure. So today that's what we're gonna kind of spend some time to make sure you understand how that works, because you need to. So because this is an active investment, there's going to be fees. And the reason is because there's, like we talked about before, there's a manager or managers that are overseeing this bubble. And inside this bubble, they're continuously buying and eliminating positions based on what the market is doing. It's active management. And that fund manager, that team, is sometimes raising cash when the market is getting volatile. And then when the market calms down, they may take the cash and then go buy more positions. When they sell positions, it either is going to give you a gain or a loss on that. And that gain and loss stays inside this bubble and just keeps getting reinvested all the time. Except the difference with mutual funds is at the end of the year, so at 12/31 or before usually, by law, these mutual funds, if there's a gain, has to push out 90% of that gain at or before to you. And so sometimes you'll hear from people that, mutual funds cause income tax consequences on non-retirement accounts. Remember, in a retirement account, all this activity happening inside your 401k, 403b, retirement, IRA, etc., there's no tax on any of that activity, because as long as you don't take any of that money, that's the only time you ever pay tax on a retirement plan. So inside a retirement account, you could care less about the taxes because there's none to you as long as you don't take a distribution. But in a non-retirement account, you just got to make sure that you understand that when there's gains, that you're going to get money pushed to you through what's called capital gains. And so capital gain distributions are taxed at 15% max. And so while people complain about, mutual fund distributions are bad, they could be, an adverse tax impact. I mean, they can sometimes, yes, but remember that this is income being pushed to you on your tax return, but that money comes back into the fund and gets reinvested. And so just like a dividend gets paid with these different bubbles inside this big bubble, all that money is just continuously circulating, and occasionally you may have to pay tax. And to me, taxes are always a compliment. When people don't pay tax unless they make money. So it's just a matter of just making sure that you sit down with your tax advisor to understand that. So let's talk about fee structure. The problem with mutual funds is that there's so many mutual fund share classes, and that's why these sources will help you out. And so I have clients that I talk to that, we manage portfolios and we charge a fee. And some people say, well, I'd rather just buy it by myself. It's cheaper than what I pay you. And, my best example I've ever talked to clients about is that, so before the tax law changed recently, in 2018, you could write off advisor fees or brokerage fees. And I remember I was sitting down with a client and I said, well, how much does your advisor charge? And the client said, yeah, my advisor charges nothing. And I go, wow, that's kind of amazing that advisor would do something for free. And so I said, do you mind if we call your advisor's office and we go over the fee structure just to make sure, because we can write the deduction off for brokerage fees back in 2018. So we called the brokerage firm up and the assistant answers, and the fees were $23,000. And this is how the client doesn't see that happening, but it's happening, and that's through share classes. So here's my in-depth insight on share class. So there can be, depending on the type of mutual fund you buy, there can be A shares, B shares, C shares, F1 shares, F2 shares. I mean, you could literally keep going. Some, depending on the mutual fund that you're buying, could have 10, 5 different share classes, all depending on, and I put I here because this is the most common if you have your money invested. So A, just think about this, is A, front of the alphabet, you're getting front load charged on your mutual fund. And depending on what mutual fund that is, it could be as high as 5%. And the bad thing, obviously, with that is that you're already taking a 5% hit on your account. And second of all, you don't see it on your statement. So when that client in my example thought she was paying no fees, it's because when you looked at her account, she was paying front-loaded fees on the mutual shares and never seeing the fees. They were just being deducted from the account balance. And when we got the tax record, the 1099, usually it shows you what the advisor fees are. And if you're paying it through these fund fees, you're not going to see it. And so unless you're using something like these resources to show you what fees you're paying, most likely you're not going to know. And that's why many times it's much cheaper to have somebody manage your money, because you're usually buying what's called iShares, and these are no load funds that your advisor can buy for you, where you can't buy those. So yeah, you got to pay them a fee to manage the money, but again, they're buying and selling and trading and actively managing that money, and it's much cheaper than the A shares that you're buying. And B shares are just backloaded, so you're paying them when you sell them. C shares, or you're just paying them as you go along. And all these other share classes are depending on what type of investor you are, what type of relationship you have with the brokerage firm, how much money you have in your account. It's unbelievable, to be honest with you. But you as an investor get to make the decision. If you don't want somebody to manage the money for you and you're going to do it yourself, you're going to most likely pay these types of share classes, which can be much more expensive over time depending how much trading you're doing. And think about, just common sense wise, I buy an A share and I pay 5%. If you buy it at a brokerage firm, they're not going to let you usually trade that A share until you make up that money. And so you're kind of stuck in that investment until you make up the commission. Whereas if you're paying somebody to manage your money and you're buying an iShare with a no load, that's why sometimes your advisor can do trades on a daily, weekly, it doesn't matter. They're not doing it to make you more money because they've already made the money on the management fee. They're just doing it to keep your money typically. And the beauty of the iShare or having somebody advise you is that you can buy and sell the market. Let's say you buy a fund today and the market drops and now you want to get out of that fund. In an iShare, I can move out quickly if I want to, because I don't care. You didn't pay a front load fee. Whereas if you bought an A share, then most likely you're not going to be able to get out of that investment because you're not breaking even on your fees. And bigger brokerage firms are going to make sure that you understand that you can't just get in and out when you're buying A shares, and typically B shares or C. You just got to make sure that every fund is different. And that's where it gets complicated. So again, the only way to make sure that you understand is when you're meeting with an advisor, either it's your current one or you're doing an interview, you should always ask them, what's the different ways that I can get charged? And you want people to be as transparent as possible. Again, it goes back to knowledge makes you more comfortable. So I'm going to leave you with that. Again, I can get much more in depth, but we're not going to do that. That'll make your head hurt. I'm not trying to make you do your own seminars. I just want to give you enough information, I always say, just to be dangerous. So before you buy any type of mutual fund, you should understand that you can plug them into these types of resources. It'll give you the fee structure, the performance, the holdings. It'll be super transparent and give it to you, usually in a nice summary, and that can help you with some discussions with your advisor if you are managing the money through a brokerage account where you're doing it yourself. If you have any questions, as usual, taxandtrusthelp@gmail.com. I really appreciate you taking the time out. I know this is complicated sometimes, again, more than we ever thought it would be with money. But again, more information that you have, the more knowledgeable you are, the more comfortable you feel. Have a great day. Thanks so much.